Coming up in today's episode, we speak about Anthropic. It's one of the biggest businesses to go public, and everyone is talking about this. It's so fascinating, and rather than doing too many stories today, we spend quite a bit of time unpacking this.
And we do a bit of compare and contrast with the .com bubble, and is this going to be an AI bubble? Should we steer clear? Should we keep investing? What should we do? We break it down.
One of the most famous, successful investors of all time, Warren Buffett, has recently stepped away from being at the helm of Berkshire Hathaway, his investment company. There have been some really interesting investments made by the new person in charge. So we basically talk about, do we think these are total disasters or actually really good investments?
And in the podcasting space, there looks like there's going to be a new Alex Cooper. A podcast has been bought for $100 million.
I think the most interesting part of this, Netflix and Spotify have bought it. So it's not just one owner, it's two. So we break down what does this mean for the whole industry.
This is The Curve Weekly, where we read the finance news so you don't have to. I'm Vic Harris. I'm a finance professional and have made a career out of making money for other people.
And I'm Sophie Hallwright, an ex-TV radio producer who was just very sick and tired of not understanding the economy or anything about money. So we started this podcast.
We're also joined by our producer, Emily Rigby, and our social media manager, Lucy Munro, who are behind the scenes making this podcast possible.
But before we dive in, we've got a quick word from today's sponsor.
This episode of The Curve Weekly is made possible by Pathfinder KiwiSaver Plan, helping you invest alongside your values.
Pathfinder's won Mindful Money Best Ethical Investing Provider for 5 years running. So we've teamed up with them to bring you the Ethical Hotline.
Got questions about the ethics of an investment or unsure where you draw the line?
Submit your questions via the link in the podcast show notes, and thank you so much to Pathfinder for making this episode of The Curve Weekly possible. Pathfinder Asset Management Limited is the issuer of the Pathfinder KiwiSaver Plan. A product disclosure statement is available at pathfinder.kiwi. I wonder if anyone's seen us on the news.
Yeah. Because any Aussie pals seen us on Channel 7?
We have an interview at 1 a.m. UK time, which I will say, if there's anyone that's dedicated to the cause, it's us, because that's
So I was like,
mental.
are you all good to do it? I was like, absolutely not.
Excuse me?
We are in this together.
Oh, yeah. Vic's like, no, I think it's really important we both are there. I'm like, no, you don't. You just want me up at 1 a.m.
We both can suffer. No, really exciting opportunity, and we're really thankful.
Sorry, if our agents are listening, thank you for the opportunity.
It's the morning show on Channel 7.
We're basically talking about what you do when kids leave home, how you think about your finances, how do you plan for the next sort of 20, 30 years. And when we were planning for it, I was thinking this is actually quite good content too. Maybe we should make the podcast out of this. But yes.
But maybe we should record the podcast like at 1 a.m. same time.
Absolutely not.
Yeah.
Are you going home to have a nap?
No.
Are you going to power through?
Yeah.
I think I'm going to go home and have a sleep, and then
I'll be so groggy. Like waking up.
So this is my plan. I'm going to
No,
finish.
you're going to sleep through the whole thing. You're not going to wake up.
No.
You're going to be like, my alarm didn't go off.
No,
Sorry,
no,
babe.
No, I've got a full-on alarm clock.
No.
Excuse me.
No, you're saying it worked till 1 a.m.
No.
I'm
Because
sorry.
I've been here since 7. I'm not doing that.
No.
My plan is 3 p.m. I'm going to go home, and then I'm going to come in for the interview, and then I'm going to work all through the night, and then I'm going to finish for the weekend.
I'm working. It's quite good. I was saying to Plummy, and I was like, oh, it's great. I can have meetings with New Zealand right up until 1 a.m. So I'm going to
You're working the opposite way.
Yeah.
Maybe I'll do that then. I'll work through, and then I'll just take tomorrow off, because if I'm working till 2 in the morning, that's just ridiculous.
Anyway, let's
moving on. Okay, moving on. There has been
Everyone's like, we saw you as shit, so move on.
It was bad. If I were you, I would just bury that under the rug and not talk about it.
You definitely should have had a nap. God, it's like every podcast record, it's like another IPO. It's great.
I know.
Well, it's not really great, but like
Is it
is.
great?
Well, yeah, I mean, yeah.
But there was a time where we had this podcast where no businesses were going on the stock market.
Yeah.
There were no new companies. And now we've got this.
Now it's like an IPO a day.
It's quite fun. And I will say, for anyone that does not date somebody that A, reads the Financial Times, or B, maybe reads the news themselves, you may have missed this, but everybody is talking about this particular business that's about to go public. I was going to say shaking some tail feathers. That's not what I'm looking for, right?
It's really ruffling some feathers.
It's ruffling some feathers. It's a big deal.
It is a big deal. Anthropic. People might have thought we were talking about SpaceX. No.
Don't you worry.
Listen to last week's.
Yeah. This is another new one,
Another new one, Anthropic. So Anthropic is the AI company behind Claude, and they have confidentially, I mean, it's not confidential, but confidentially filed their paperwork to go public, which means you and I will be able to buy their shares on the stock exchange very, very shortly, which is super exciting. The company is going to be valued just under $1 trillion. So remember, we had SpaceX IPOing at 1.8 trillion, and now we've got Anthropic, which is going to be around about $1 trillion as well, which is crazy.
So before we get into the numbers and what this means for the stock market, let's just remind people this business is run by a brother and a sister duo. They used to work at
Dario and Daniela.
And so they are both estimated to be worth around 7 billion each, which is absolutely crazy. But the best part about this story is that they used to work at ChatGPT, OpenAI, and then they went and started Anthropic as the competitor. So this is kind of juicy and exciting.
And they got asked to go back to OpenAI.
Yeah.
And they were like, nah.
It would be like Emily, our producer, going and creating the Swerve, which is all about finance news and investing, and then all of a sudden it being this huge, massive podcast that's like really a rival to us, and our biggest competition is the business Emily built. That would be the equivalent.
And we're scrambling to IPO as well. But we're not going to IPO for as much. But Emily's IPOing at, nearly $1 trillion. And we're like maybe 900 billion.
I actually went to South by Southwest. I went to South by Southwest in London yesterday. And I was listening to a bunch of people in the podcasting space talk about podcasting. And there was like the Acast CEO or founder, or like someone really high up at Acast. And then there was Christiana, I can't remember her last name, but she's now the CEO and founder of Flight Story, which is a massive competitor to Acast. And they were on this panel together talking about the future of podcasting, and you could just tell it was uncomfortable. You were like, you left this business to go and kind of start this other one. You're like, oh my God. But yes, I think there's just like a lot of details to the story that's made it quite interesting. But the main reason people are talking about this is that SpaceX and now Anthropic are two of the biggest companies to ever go public.
Yeah, and they're both AI companies. SpaceX is to an extent, and so is Anthropic, and then we've got OpenAI coming. Like, that is just so much money and like highly valued businesses that are coming to market in the AI space. Like, if that doesn't scream bubble to me, I don't know what does. Anyway, I'm not calling a bubble. I'm just saying that.
But it is a bubble, though. Right?
It's just
kind of
like, I mean, if we take SpaceX, you're IPOing 100 times your revenue. Like, it's kind of like when you start seeing numbers like that and like $1 trillion, it's like hype and exuberance, and it's not normal.
It's also not really real, right? Like, if you think about when people value a company, often it's based on a revenue multiple. So, 4 or 5 times your revenue.
Or earnings, but neither of these companies are making earnings.
Which is kind of the point, right? So, like, the value of what you're paying for the business is
a multiple of profit or revenue. Yeah.
Which, did you just say it's 100 times?
100 times revenue, SpaceX.
So often when you talk about buying a share in a company, and this is something we don't talk about a lot on the podcast because it's kind of complicated, but the whole price to earnings ratio situation, right? Like, if you're looking at an investment, you're trying to decide, is it valued right, or am I getting a good deal here, is kind of important, because this is technically like...
Well, you look at it versus competitors, and like if you were buying Amazon and it was 20 times, the share price was 20 times its earnings, versus Google, which was 10 times, then you'd be like, oh, well, Google looks more attractive. So you're trying to like compare companies in the same industry or one company kind of over time. But it's the key thing with Anthropic is that it is expected to earn a profit in the first half of this year. So it is... I guess if you were going to buy an AI business that proves it can be profitable, then you'd be buying Anthropic. Like, it's a proven model. OpenAI still hasn't generated a profit. SpaceX hasn't. Like, when you buy a company, you're buying its profitability, its future growth, its future profitability. So it's like the fact that Anthropic gives me like great comfort in being like, okay, they're onto something here and something sustainable. They've got 500 corporate clients spending over $1 million a year with them. That's only 500 corporates in the world. Like, you just think about how much we are using it, and we are such a small business. We are a blip. Every day it brings out something new. So you're bringing out new uses or new products. You've got new customers. There's just so much growth still to go. And that's why people are flocking to AI, is because there's just an increasingly expanding market of its uses. They have increased their revenue 5 times. So 5 times over. It's multiplied 5 times since January to May. So each month they're effectively doubling their revenue. And in March 2025, so like a year ago, this company was valued about 60 billion. And it's now going to be valued at a trillion. Like the growth they're just seeing is like out the gate. The one thing here is that the investment banks that are taking this to market and effectively like help the business access clients and actually get it across the line, they're getting around 500 million in fees for taking this company public. Like that is wild. And I was like, hang on a second, maybe that's the investment angle, is to invest in the banks when you've got 3 of the world's biggest IPOs coming to market this year. If say like it's JP Morgan, Goldman Sachs and Morgan Stanley that are on this deal, if I saw that like Goldman Sachs was on all 3, I'd be like, fuck, I'm investing in Goldman Sachs.
Yeah.
But that's the whole question with this whole AI space is like you have these tech companies investing billions and billions of dollars. Alphabet we'll get to in a second, just doing a capital raise to raise money to invest more in AI. And that's the biggest question is like, will this come, or all these companies investing and we actually don't expect the AI demand to be there? That's the big question. That's what you kind of have to, everyone's kind of researching and trying to figure out. And when, you've got NVIDIA coming out with a great result, you've got Amazon, you've got Google, you've got Microsoft, you've got AMD, which is like the second to NVIDIA, all of them coming out with these fantastic results, just saying demand's booming. It makes you think, okay, we are still just the beginning of this like revolutionary change.
The reason, the bubble situation that we mentioned before, which is what a lot of, I would say finance bureaus, but anyone really in the finance space or investing world is fixating on, is the idea that there has historically been lots of times, not lots, but like the .com, but I don't know a huge amount about it, but essentially there was all these businesses that started getting enormous valuations.
And they had no earnings
and they had no
revenue,
yeah.
Some of them. So it's like, it's like if we compare this, because it does scare me when you have 3 companies this size potentially coming to market, so OpenAI, SpaceX and Anthropic, and 2 of them are loss-making. All 3 of them are betting on super high demand from AI to continue for years and years and years. So it does kind of scream, okay, are we at the top of the market? Is this the start of like a correction? I don't know. And so starting to look at, the similarities between the .com bubble and where we are now. And the .com bubble was like in the late 1990s. And it was when the internet had just come into play. So everyone was like, oh my gosh, the internet's going to change the world, which kind of definitely has. And between 1995 and 2000, the NASDAQ stock index, which was kind of the tech focused one, so very similar to S&P 500, but more tech companies, and which has got all the tech companies we know today are on it, that increased 5 times in 5 years. So it like went from 1,000 to like 5,000. So it was just incredible growth. And companies with no revenue, no profits, even sometimes no product, were being valued at like over $1 billion. So that it just shows the exuberance of everyone being like, this internet thing is going to be crazy. I want to invest in anything and everything, and not having the acumen or the woo, like just chill. Everyone's getting into the hype, and then you hear people talking, have you invested in this internet company? Oh, I have, and it creates this FOMO, and anything that had .com in its name, kind of like now with anything that's like AI, was just valued at a ridiculous valuation, and there was nothing like tangible. Whereas at least with Anthropic, you've got profits. That is tangible. You've got something to fall back on.
And I'd love to talk about the poster child for the .com bubble and what happened with pets.com, because I feel like that's such a good example of this. And what is easy to forget is that while there was a .com bubble and there was all these businesses like pet.com, which we'll talk about in a second, there were also some amazing companies that came out of it that are still huge today and a massive part of the stock market. So while there are people floundering around kind of selling fake news and fake businesses and raising all this money, there are also at the same time businesses that did really well out of the .com age.
Totally. And it's always opportunistic. When a company IPOs, they're not doing it when the AI space is in the toilet and people aren't excited. It's like with Allbirds. They IPO'd and did that when sustainability and like all of that was so hot and wellness and fitness. And like they IPO'd at the perfect time. And we're the stupid ones that get caught up in the hype and don't focus on the fundamentals of a business. Yeah, there's a saying that Warren Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So it's like, it's way better to wait or, you know, find a company that's kind of, I guess, undervalued, or people, you know, it's had oversight from people are kind of ignoring it, but it's a wonderful company. It just doesn't have the exuberance and everything, than pay for a company like, you know, could be Anthropic or SpaceX, which is super exciting and super shiny, but they're just like an okay company, you know.
Can you explain what happened with pets.com? Because I think that would be an example of paying a fair price. No. Ugh.
A wonderful price for a fair company.
But to be fair, it's not even a good company. And that was kind of the whole point of this.
So it IPO'd in February 2000, and the market fell off a cliff in March 2000. It raised $82 million, and it was bankrupt 9 months later.
So people saw pets.com and thought, perfect, I'm going to buy
.com in
it.
it.
Oh my God. And it became this huge thing. People bought it. They got
It was
all
an
this
online
money in.
pet delivery company. Did you say that? Or I can't remember if you said that.
No, we didn't. It was an
okay.
online, and basically it was famous because it spent more money on its Super Bowl ad than it made in revenue ever. What?
Yeah.
Pet delivery company.
Oh, pet food delivery.
Oh my God, I didn't even think. Here's a cat. Here's a dog.
Here's a goldfish. I had a goldfish company.
Oh,
Do you remember?
What do we call it? A company? Sorry, you're right. But it
Little budding entrepreneur Vic here when she's like 17, and we had like young enterprises.
17. Who the hell is buying a goldfish at 17?
It was really cool to like walk around school with a goldfish in it.
God.
And this is a great example of, you know, probably being a wonderful priced company at a, I don't know.
It was basically Vic was taking advantage of the .com bubble. She saw pets.com is there and she
No.
thought, I'll get goldfish to school.
I saw Finding Nemo just launched, and everyone was like, "Oh my God, so cute! I want a Finding Nemo!" And we were like, "Cool, let's sell goldfish."
I mean, it is quite clever.
And we got fish delivered to school, and everyone was walking around with it like it was the best marketing. Anyway,
Did you have a logo on your plastic bag with the fish on
I
it?
spray painted my dad's fishing rod, and he lost it.
What did you
I
do
spray
with it?
painted it orange because it was like orange was our color.
It's
And
genius.
he told me I couldn't, and I just went ahead and did it.
You were such a little shit.
And he to this day is not let me forget. I'm like, it was a bloody fishing rod, mate. Like, but there's a fishing rod and there's a fishing rod, and it was
and
a
you did
fishing
the
rod.
Oh
yeah.
no!
Yeah.
Like the big circles. It's
Yeah.
got the big. It's
like
proper
really good,
rod. Stick?
like the
string.
lure.
Yeah, I know
don't
exactly what you mean, and it's got a really seamless thing that
Yeah.
goes up and down and up and down. You know, like the.
You're riding a horse.
Oh God! Okay, back to it. So,
Yeah.
okay, so the reason we're bringing this up, so Pet.com was
An online pet food delivery company.
so they famously spent more money on their Super Bowl ad than they made in revenue ever. Not a great business.
Not a great
Didn't
business.
do well.
Yeah, so the bubble burst in March 2000, and the average internet company lost 88% of its value. And the NASDAQ stock index declined about 80%. And 15 years later is what it took to get back to those levels.
This is why people are panicking because they're looking at all these enormous companies that are going public for the first time. They have these huge valuations people are obsessed with. If you have .ai in your website, if you have anything, people love it.
Oh my God. So I'm doing this talk at London Tech Week, and I feel like wanting to put the curve AI.
Do it.
Everyone else on these panels is like genius AI, like all this, like every
Just change
company is
it.
AI, and I'm like, hi, with a curve. You know, like I just
.ai.
just don't
Just do it.
curve AI. Everyone will be like, oh, do you guys do AI?
Maybe
Like,
we should
use
be.
it.
You should do. We should be the pets.com, you know, and
Yeah.
get people to invest 100 million. But
Anyway.
the whole point to this is that because it took 15 years for the NASDAQ to recover, so it was doing so well, like,
Yeah,
oh
and then-
my God, we're absolutely peaking it. And then it fell off a cliff and it took 15 years for it to recover. Like, imagine if you had $1 million $1 million in the stock market, and it fell like that, and it took you 15 years to get back to that. So a lot of people are thinking, should I be pulling my money out of the US? Is this going to happen? Is the bubble going to pop? And for us, for me, I'm putting £20 or whatever, and not a big deal. If you have a huge amount of wealth and all these people are talking about it being a bubble, quite scary to think you could just overnight lose a huge amount of wealth.
Well, it's also, people that are close to retirement that might not have 15 years to build it back up. But I read these headlines like pets.com and I'm like, will we be sitting here in a few years, in 5 years, in 10 years going, yeah, and we had 3 companies thinking they could IPO for $1 trillion, and it's happened again? Because we're sitting here going, this is crazy. These companies, like 100 times revenue. Like, I'm trying to be like, will we be sitting here looking back on this being like, yes, that was ridiculous. Or is this the new norm? Like, that's how you're kind of trying to think about it. And when people invested in pets.com or companies like it, they lost their rationality. It was a FOMO trade. It was people getting FOMO and wanting to invest in these internet companies because everyone else was, which made the stock market go up and up and up and up and up, and they just lost their, sticking to their knitting and being like, no, I'm only going to invest in companies that have earnings, or I'm only going to invest in companies that actually have a product or that actually show, consistent revenue growth. Like,
but I think the thing that's hard with this though is that because they're going straight into indexes. For example, an ETF, if you aren't stock picking and you're just buying the market, or you're buying, then and then it falls by a huge amount, because the reality is there's going to be businesses that end up being the Amazons or the Googles, but the AI version, maybe it is Amazon and Google, but it's more the idea that the dot-com bubble had incredible businesses come out of it. There's still going to be amazing AI businesses. It's just that there might also be a whole lot of shit ones too. And if the whole market crashes because there's so much exuberance, and even though, there might be 3 or 4 that are amazing that stand the test of time, if you've invested mainly in ETFs or indexes or whatever, and you're just following the market, then you follow those big falls. And I think that's what I'm kind of like, how are you meant to know what to do with your money? I have a lot of friends and people close to me that use index funds to invest. And so they're basically following the market. They've picked the top 500 companies in America, they've got the S&P 500, they've got global indexes, they've got things like that, but they're definitely not stock picking because they're fine following the market. And I think for a long time, ETFs and that type of investing has been great because it's been steadily going up. But now that it's almost scary, I think some of those people, particularly the ones that have a decent amount invested now, are like, well, I don't really want to, maybe lose 85% of my investments to then wait 15 years for it to come back. They're trying to be a bit more active or...
Yeah, and you're so spot on. Like, that's ETFs have done, and index funds have done so well over the last 10 years because the market's just gone up and up and up and up and up. And the way to prevent that massive impact of your portfolio falling 80% like the index is to be, using a professional investor that is trying to not only do better than the market when it goes up, but also protect your money on the way down. And so they're constantly researching, being like, okay, if we are in a, heading into a .com era again, what are the companies that are going to survive? Or what should we be investing in that's not related to AI, that's also going to do well? And how do we protect your money as well as grow it in those times when the market does well?
I think if you've got a decent amount of wealth, for example, if I had 500,000 invested in the stock market right now and it was in indexes, I think I would feel quite stressed out. Because you are just following what the market does, which if there is a bubble, you'd be so gutted. And I think that's why a lot of people are trying to figure out, well, should I pull it out and put it into, but that's where you get into territory of well, that's what the professionals do. Maybe you should just be,
give your money to a professional to make that decision. And they'll have all the information to see, okay, will this AI demand still continue for the next, 3, 4, 5, 10 years? Or are we looking like we're at a peak and therefore should we start looking at other things to invest in? That's why you pay them.
Yeah.
We could talk about this for ages.
I think the reason that I find this bit really interesting is that we always say invest for the long term, you know, and that makes sense for sure. I'm not going to need the money in the stock market that I have in there for 15 years. So if it totally tanks, it's fine. I'm not going to be pulling that out. But it's so different for me with someone that doesn't have a huge amount of money in there compared to people who do and that are thinking, if I'm overexposed to the US and there's all these companies, you know, and your money is up here, I don't know. I think it's a bit scarier when you're dealing with bigger amounts of money, is what I'm saying. And I would not want to be making those decisions by myself in my bedroom, looking at articles and deciding if I think that they are, you know what I mean? Like it's a classic finance bro in terms of making a decision. Don't do that.
It's so funny. I was getting coffee the other morning and this guy had his headphones in and he was like, he had this tote that said JP Morgan. I was like, oh. And anyway, and then he's like, nah, bro, market never goes down in the midterms.
Oh.
Like, which is obviously the midterm elections in the US. And I was like, must research that. Like, have they gone down? You know, like I was like, oh, interesting. Like, but I was also like, yeah, they do. I just wanted to like have some rebuttal, but I was like, oh, he just like the epitome is so. I'm like, do you realize? Like,
they must know that they're a cliche,
yeah.
But maybe not.
But anyway, I guess I don't think the question is like, are we at a bubble yet or not? I think it's if you are investing in stock picking, just make sure that you're investing in quality companies. I think is really important.
A lot of people feel scared about investing right now, but then a lot of people felt scared when markets were on the floor. You know, everyone's always scared. So like looking at actually what's happened at different times in history is the only data you can go off. Yeah.
And look, when you're not going to get it right, even the best people in the world don't get it right. You know, it's
imagine the pressure right now. Do I invest in it? Don't I? Oh, I'm so glad that's not me.
Yeah. Imagine having billions and billions of client money and you have to make a call.
Nah.
You know, you're like, do I invest my £20? Yeah.
It's so much easier.
Do I invest my clients 20 billion?
Shit.
But also, if you don't invest in it and it does well, then you've got to answer to your clients, like, why did you not invest in it? So it's there's so much to it. Coming up after the break, we talk about Berkshire Hathaway, which is the investment company that Warren Buffett used to run, but they've now got a new leader and he's making some mega investment decisions.
But first, we've got a word from today's sponsor. Something that we often get asked is whether you can actually invest ethically.
It's such a common concern. Honestly, a lot of people think money is bad, and so they assume that investing must be too.
Yeah, I feel like pre-2000s, most investing focused entirely on profits, and that was above planet, people, all of those things. But things have changed now, and it's so much easier to invest in a way that balances both financial returns as well as doing the right thing.
And that's why we've partnered with Pathfinder, because they make ethical investing understandable and accessible. Thanks to Pathfinder for making this episode of The Curve Weekly possible.
Pathfinder Asset Management Limited is the issuer of the Pathfinder KiwiSaver plan. A product disclosure statement is available at pathfinder.kiwi. So we've got a change of pace here. We're talking about a whole new industry, and it's called AI. The reason that this is interesting is because Warren Buffett is the granddaddy of investing. He is just the OG hot buy and hold. And he's retired after a very, 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 very long stint.
Very long
How
stint.
old was he when he retired? It was this year, right?
He's in his 90s. Yeah.
So he's an amazing investor, and he's delivered incredible returns. And Berkshire Hathaway is one of those businesses where people love it, and it's done amazingly well, but it's also had a really signature investing style.
Yeah.
So the reason that this story is super interesting is the person that's now taken over is seemingly doing kind of the opposite, right?
Yeah. Oh, he's been there like a couple of months, and he has already made 2 massive investments. And everyone's like, whoa. Like Warren Buffett, they were sitting on, remember that, and we've spoken about this, about $360 billion of cash, the most cash they've ever had. And he's just gone boom, boom this week and just dropped $10 billion into Alphabet, which we'll get to in a second, and about $7 billion into a home builder in the US. So he's definitely spending that cash. Quite fun. Imagine if the Curve had $300 billion and we just gave it to someone else.
I'm like, I actually think I'd be scared of you having that much money for some reason. I'm like, where would it go?
No, you'd be like, Vic, where are you? Vic?
She's like,
anyone seen her? Our bank balance is depleted.
I have a theory on this. You know how we've been speaking for ages that they've been sitting on all this cash, and all of a sudden he's made these decisions. There is no way that he wasn't consulting, talking to Warren Buffett, and I almost wonder if it's a bit of a tactic.
Yeah.
You know, like they were going to go and make these big investments. Of course, they researched them for a long time, and now have made that decision when he's leading it.
Yeah.
So that probably it gets a bit of investor confidence because it will do well. And then people are like, oh, he knows what he's doing. Okay, cool, I trust him.
Yeah.
Like it's a perfect hand the baton to be like, oh, what are you going to do? And everyone's looking at him. But actually secretly everything he's decided to do is endorsed by Warren Buffett.
Which is like so humble,
which is
right?
so cute. Go, Warren Buffett, he's the
Not like,
cutest
no,
ever.
I want to go out with a bang and I want to do 2 last deals. He's like,
So
no,
true.
you take it. You take it, Greg.
Yeah. Is it Greg?
Yeah. But the thing that people are looking at here and kind of a bit confused about is Warren Buffett and Berkshire Hathaway has always kind of been a bit averse to technology. So they've always said, you know, and Warren Buffett's been like, that's a space I don't know. Like, I'm not going to jump into it. Even when they invested in Apple, everyone was like, whoa. But he was like, no, that's a consumer company, essentially. That's why I like it, got good brand, rah, rah, rah. And now they've invested a little bit in Alphabet before, so there's Google. And now they've kind of doubled down. And let's just remember, like, Google is up a ridiculous amount this year. So when we talk about that quote before around investing in a wonderful company at a fair price, people were like, hang on a second. And then the flow-on question from that is like, well, what do you see or know that we don't? And therefore, should we be investing in Alphabet as well? Because you have had such a consistent track record. You're also a new CEO. You don't want to like rock the boat or like do anything outrageous that's going to change the investment strategy. So yeah, it's like you're doubling down on Alphabet and AI in particular, because Alphabet's effectively an AI play now.
I just don't think that strategy of not investing in tech is going to work when it's almost like saying, I don't invest in the internet and then not changing your play at all and continuing to...
But for 60 years, Warren Buffett has delivered like the best returns ever out of anyone. He's the world's best investor. Yeah, that's a function of sticking true to your strategy, what you know does well, compounding over years after years after years, and not being flippant and changing your strategy when there's like new and exciting things happening and being like, oh, oil, oh, you know, like you're taking the longest bets. You're going, what does the world look like in 20 years' time?
And they're now betting on AI.
Yeah. Alphabet. So I mentioned that Berkshire Hathaway is investing $10 billion in Alphabet. Alphabet is doing a capital raise, so they're going to the market and being like, "Hey, we need more money off you as our investors. We need $80 billion to help finance AI infrastructure, so like data centers essentially, because they say that they're seeing demand exceeding supply. So they're seeing we just can't keep up. We need to go to the market. We need more money. We can't pay for this out of our cash or out of our profits. We need $80 billion. And this is only the second time in 20 years that Google has ever raised money.
Whoa.
Yeah.
That's huge.
Everything else has been funded by its cash and its profit and taken on debt, for example. But
wow, that's actually massive.
yeah.
What does that say? Is it basically the idea that they believe in it so much that they want to go fast?
The confusing thing was it was buying back its own shares not that long ago. Like, why were you buying back your shares and not using that money to invest?
Because buying back shares, for anyone that doesn't know, is basically like saying, we believe in this business so much, we want to own as much as possible.
But also, we don't have any use for this cash right now except buying our own shares.
Yeah.
So it's like,
okay,
yeah.
So that's an interesting point.
Yeah, it's like we've got this cash and we could invest over here, we could buy this business, but there's nothing really, and the best return on that cash is to buy our own shares back and spend it that way. So then to now kind of reverse that and be like, oh, actually, we've found this investment that we need to make. It's just a bit weird.
Because obviously to get money in to spend on AI, they have to make new shares.
But then the cynic in me would say that when a company buys its own shares, which it was, buying over $60 billion of stock last year, that boosts up the share price because it's a green flag. It's like a great signal. So that increases the share price. And now you can do a capital raise at a much higher price because the share price is up here.
I mean, that makes sense.
Yeah.
That's sort of what they've done. That's not cynic. I think that's been clear.
Yeah. I mean, it's a bit like, I'd be not pissed off, but I'd be like, guys, come on. It's pretty obvious what you did.
Is it?
Well, it's like, come on. Why didn't you just use that money? I guess it's probably a good decision, good financial decision, because the share price has gone up. Yeah.
Kind of love that.
It'd be worse if it didn't actually support the share price and the share price went down and then you've spent this money, you got to raise down here. Yeah. So
How much are they raising?
80 billion. And 10 billion of that Berkshire Hathaway's giving to them.
Oh, okay. So they've obviously got a plan.
Yeah.
Are they going to tell investors what they're spending and what their plan is?
It's to finance AI infrastructure investments.
Could you be more
I know.
vague? Bloody hell. That's so interesting though.
Yeah.
Oh, I really want to know. I wish, it's so funny because I've been like reflecting on the Kirk Weekly in general because in the not so distant future, we're going to be doing more news like this. And I was looking at old episodes and the sorts of things we used to speak about and reflecting on, well, I was just thinking, I remember when you would talk about this stuff and I was so bloody bored and just had no interest in it.
Yeah.
And I remember some of the things that you would talk about and you would say like, oh, it's so interesting because I get to, listen to all the CEO's plans. And I'm like, oh my God, I'm falling asleep. But the idea of knowing what Anthropic is saying that they will be doing, like what is their big plan? What are they pitching? Or what is Amazon's or Alphabet's plan? Like, what do they pitch? I'd love to know.
Yeah. And like the reason Anthropic is coming to market and IPOing is to raise money to spend on growth. That's why most companies IPO. I know we spoke about Lime and we spoke about them IPOing to pay down debt, but you're still raising money to do something with it. So it's like, it's the same with Anthropic. They're raising money to spend on growth so that they can grow faster and reach more customers and roll out more products and all of that. So
it's like, what are you doing though? Like, tell me your plan.
Yeah.
Because like I was, let's not go back to Anthropic, but I was thinking like the amount of growth that they're almost saying they're going to see makes me think they're going into almost every industry, They must be able to say we can disrupt basically every single industry with this money, like in terms of, I don't know, creating drugs that are going to be revolutionary. We can use this technology to do, that must be how they're proving the long term.
There will be investors that sell out as well. If the valuation of the business has gone up 5 times in a year, there'll be founders and employees from the beginning that will be selling out. Like, yes, Dario and
like getting
taking
money,
a little bit off the table
I
and
see.
being like, there'll be employees that have been there from day one that probably got equity.
I want to go buy some boats.
Yeah.
Give me some money.
Let's finish on a non-AI topic.
Yeah.
Jay Shetty. So his On Purpose podcast, which is one of the world's most popular podcasts, they've got 1 billion listens.
I was about to say, I cannot believe it's 1 billion.
I can't wait for the day that we can say we've got 1 billion
1
listens.
billion. You'll be dead, I reckon, by the time that happens.
Hey,
Also,
ambitious.
sorry, but also,
No.
can we just talk about how weird is that to think that our podcast is going to be around when we're dead?
Yeah.
That's so weird.
Legacy.
Like, isn't that so weird? To people can go back and listen to us talk for hours and hours and hours. Bizarre. Anyway, so I think I mentioned earlier in the podcast, I went to South by Southwest, and this was one of the things that came up quite a lot. Just the idea of what is shifting in this industry, what it means for the media space in general, what it means for advertisers, what it means for, it's just basically what this signals to me is an enormous shift in the way that people are perceiving podcasting, really.
We haven't even told people what's
I know.
happening.
I hope they're sitting on the edge of their seats, absolutely
So
gagging to know.
So Jay Shetty has signed an exclusive video deal with Spotify and Netflix simultaneously. So this deal is worth $100 million. And there was 3 other companies, which I'm like baffled to know who they would be, bidding at the same time. So he has just effectively jumped up to the same level as Joe Rogan and Alex Cooper right now. And as part of the deal, he's not allowed to have his video episodes on YouTube.
YouTube, for context, is the biggest place for people to use to find, watch, engage with podcast, which is odd because you would almost think that it was Spotify or Apple, but it's not. It's actually YouTube. So the fact that he won't be on YouTube is a massive loss to YouTube.
It's massive FU to Google.
Yeah. I think the interesting part here is the fact that Spotify and Netflix, who are essentially competitors, are fine to both be paying for it. I don't know what you took from that, if there's any insight or thoughts, but I would have assumed he would either have to choose Spotify or Netflix.
I hate to call it, but I'm pretty sure I called it last year.
Do you think they're going to buy it?
No, but like maybe.
But
No.
what did you say? I can't remember. Was it that you thought Netflix would buy Spotify?
I thought it'd be like a merger of
Yeah.
And then I kind of thought throughout the year, I was like, well, no, Netflix is getting into podcasting. Maybe they'll just be like, just compete head to head. I think it just shows like both of them have such dominant reaches. Like Spotify's got like 800 million users, right? And just what you can feed those users, and when you have that customer stickiness and all of that and that distribution, you've just got to keep diversifying, right? Yes, you've gone into music. The next thing is podcast. Well, they're in podcasting, but with Netflix, it's like they used to have just everyone else's content, then they had their own content. Then they went into like games. Podcasting is just such a natural next step.
I don't think it's going to be called podcasting for much longer.
No.
I think podcasting, and this is what they were saying yesterday at the festival, is just the idea that podcasts are just shows now. And you should be expecting to see, I don't know, it was interesting. You know Jamie Lang, who has Jam Pop Productions. So he has Newlyweds, blah, blah, blah. There's a whole lot of podcasts.
They are so funny.
Yeah, they're so funny.
I just find them hilarious.
Yeah, they are so funny.
Yeah.
So, and listening to him talk, I never thought I would say this, but I actually spoke to him afterwards, and I was like, if you just watch his content, you assume that he is
the funny
perhaps
guy.
the funny guy.
Yeah.
And I was like, you're the brains of the operation. You're so clever and so creative. And I was like actually really impressed with the way he was talking about the future of podcasting and shows and stuff. And he was sort of saying in the same way that when YouTube first started and everyone kind of could create, you had TV and you had only a couple of shows. And then it went into like mass, like anyone could create anything. He's like, I think you're going to almost see like a consolidation again where there ends up being less shows.
Yeah.
That are the big main ones. And he was like, we're having conversations with like Disney and all these different businesses right now. And like, so basically the ones that are going to have the money to be able to grow, it's like race to the top kind of thing. Like Jay Shetty's been bought, Alex Cooper's been bought, but not all of them will be able to survive that.
Well, it's like, it's so saturated, right?
Yeah.
And it's so hard to get sponsor dollars and like to get audience growth because there's so many podcasts now. So yeah, there will be a filtering of like, the best survive. I also think what this also signals is just like how important audience reach is and authentic audience reach. Yet the fact that Netflix and Spotify are buying reach, they're buying Jay Shetty's audience essentially.
I mean, that was the other thing that everyone was speaking about yesterday. It was just the idea that if you had money, what would you spend it on? And most people that have successful big brands are like, I would spend that on content creation. I would spend it on audience growth or partnering with people that have big audiences. And this is the whole creator economy. The people that are going to rise and end up being the biggest business owners are the ones that have access to audience.
Yeah.
And that's just because it's so hard to get people's attention. Like even whoever's listening to this podcast right now, thank you for listening, because it's a decent amount of your time, you know? Like it's a really like intimate format and you're trusting them with your time, and people are bloody busy, and with so many podcasts everywhere, it's definitely, it's such an interesting thing to see happen. And I also, I mean, they were also talking about just like how many live shows there are going to be from podcasts, and, seeing like podcast shows pop up with, 80 shows that are getting their audiences to come to this festival to see them live. The way that people are shifting in terms of how they engage with podcasts.
It's a blurring of the lines,
it's
isn't
just
it?
Content. You're just a content platform. What is your IP? What are you creating? But ultimately, it's not a podcast anymore. And so that what that also means is the way that people are spending advertising, the way that people are looking at the different platforms to distribute. People are choosing audience, which means that that's actually the most valuable thing. So the asset comes in audience, which is why Spotify and Netflix are buying these shows, because they want that audience to only be on their platforms.
Well, and the amount that Netflix spends on content, it's like billions and millions of dollars that you've got to spend to get growth, essentially. So it's like you're buying content and they're buying audience reach.
Can you imagine if your partner got $100 million deal? Like imagine if you're in a relationship, like his wife, Radi, like looks gorgeous. She just is so amazing. She's got her own podcast, which if anyone hasn't listened, actually I love. I think I actually like it more than his podcast. It's called A Really Good Cry. But imagine being in a relationship with someone that has just had that deal. That's wild to me.
I'd be like, well, we're in a relationship, so half of it's much.
Should we do a recommittal? Yeah. Do you want to get married again?
What, prenup? I don't remember saying a prenup. Oh, gosh. Quite outrageous. I hope he's got a good financial advisor.
We did just want to quickly share, on Thursday we're putting a podcast out with the amazing Ellen Joan Ford, and it was such an interesting conversation. This was all about the tension between work and personal life. I think with the space that we're in and everything we've spoken about today in terms of AI, the biggest takeaway for me was just the idea of output versus hours and actually how people are being valued, their time, their salaries. You know, like traditionally we talk about, you know, your job is 9 to 5 or 9 to 6 or whatever. It's actually like, should it be that? Should it be based on output? So it was a really interesting conversation for anyone, but particularly I think anyone that either is a mum or wants to be a mum. Just, you know, so many people go back to work and then have their salaries slashed because they are doing half the time, but generally they're still doing the same output. So it was an interesting conversation, and that one's out on Thursday. Actually, we'll play a tiny snippet just to give you a taste of what it's like and what we speak about in this episode.
What people deliver is more important than the hours that they put in. If we're clear on the value that we are prepared to pay for that particular output, then that's the value exchange. We could have a person that we pay for hours and they take twice as long because they're not as efficient. And weirdly, we'll feel more comfortable about paying that salary than we would about paying someone who can be more efficient and then go and do something else in their life that actually energizes them and they come back to work and they're on fire. We're quite literally encouraging underproductivity. We as leaders are thinking, I feel more comfortable paying that salary if I know that they're there for 40 hours, but I feel less comfortable if they're there for 20. But why? They're doing that same amount of work.
Thank you so much for listening to The Curve Weekly. Make sure you hit subscribe or follow wherever you're listening so you're always up to date with the latest finance and investing news.
And feel free to leave a comment to let us know what you thought about this episode, because we would love your feedback.
We've got new Curve Weekly episodes for you to listen to every Monday, but until then, listen to A Raising the Curve. These are our in-depth podcast episodes where we chat about all things money.
We're also around all week on socials if you're hungry for more Curve content, and all the links are in this podcast's show notes. We hope you have a great week, and we'll catch you for the next episode of The Curve Weekly on Monday.
Okay, quickly. The Curve was created to empower and educate you about investing, but we are not financial advisors.
Our platform exists for educational purposes only, and it doesn't provide personalized investing advice for your individual needs and should not be relied upon to make an investment or financial decision.
And always remember to do your own research before making any investment or financial decision.
We're here for any knowledge and support you need, but the final call is always yours.
And thanks for being here.
You got this.
Yeah, we know you got this.